Good afternoon. Welcome to Take 5. Take 5 is today dedicated to taxes, 5 minutes about international taxes. I have here Remmel van Dijk, a specialist in complex international transactions. Remmel, welcome and please introduce yourself.
Yes, thank you, Jörg. So I'm working as a partner international tax with KPMG Meiburg here in the Netherlands, and joined the firm in 2004. So now almost or already 16 years advising companies in cross-border transactions. Of course, with a focus on Dutch corporate tax, but always, let's say, with a keen eye for the international implications. So that means double tax treaties, and all those kind of arrangements. And then what you see is acquisitions, mergers, and all those type of transactions. So really like that, and it's something which is continues to develop in a rapid way, or even more rapid nowadays. We see.
Taxes are cash. That cash goes to bottom line. Can you give us some recent example where you have seen tangible tax savings?
Yes, so perhaps Jörg, I can even go a bit back in, let's say, 5 or 10 years. Then an important part of our job was really focused on what's nowadays called tax planning, where companies were really considering in creating, let's say, tax benefits by having, let's say, interest income tax deductible in the Netherlands, and not having taxable income pickup in another jurisdiction. So that was really, let's say, part of tax planning. Then, of course, in the wake of the economic crisis, so the financial crisis, 2008 and 9, the OECD started really a project which is called BEPS, base erosion and profit shifting. So that resulted in 2015 in much more recommendations and more tough rules for companies, which are now also implemented within Europe and also in the Netherlands. So what we're now focusing more and more on is to avoid double taxation. So really the trend is to help companies to avoid being taxed in multiple countries for the same item of income. That's, I think, a very important development, and it's actually still ongoing. So we now even see what we call BEPS 2, but let me pause here. This is, let's say, already an important part, and a different part, which companies are always doing, is, let's say, legal entity reduction. So you have a lot of entities, and then companies are even cross-border legally merged or otherwise transferred. And an important part of our job or my work is then to allow such a transfer without triggering any unwanted, unnecessary taxes. And that's also something what you can say is helping companies to do those transactions in a tax neutral way.
I recognize what you say, and the shift from tax planning now to avoidance of double taxation. For me, it's impressive to see that in the middle of one Europe. We are not at all one Europe when it comes to taxes. There was not a big change in the last few years, but maybe you have there some insights for a good controller. Where does he have to be careful when planning some transactions? What advice can you give to a CFO or a controller?
Yeah, so that's a good question, Jörg, and let me try to keep it as simple as possible, because the difficulty is always to make it a more technical item. But I will really say, if there's a cross-border element to any transaction, I think the best advice I can give is always to check upfront in both jurisdictions what you are considering. How does that impact taxation of any, let's say, real estate transfer taxes, unlocked gains, anything. I think that's real key to check that upfront before doing any transaction or implementation.
I think that's a wise advice, which every good controller should do anyway. It's December. We are full of Christmas preparations, but the finance world is upside down now with COVID. But can you help us? What is around the corner on January 1st in the tax world?
Yeah. Perhaps two items I can share with you, Jörg. Is I think the first one is more for the Netherlands. It's, let's say, the corporate income tax. I think everyone has seen that because, let's say, of the current situation, the earlier announced reduction of the corporate income tax rate will no longer take place. So the Dutch tax rate remains 25%. So that's something to keep in mind, because in the past it was announced that it would be reduced, although there's a step up 15% rate for the first 245,000 of profits. But that's, let's say, the Dutch side. If I really look at more the international side, as I also alluded to, that we already happy if we can avoid the double taxation of the same item of income, is that there's a really strong push international, let's say within OECD or even the inclusive framework, so that's much more countries, to let's say lower the barrier of having permanent establishments abroad, which is called BEPS 2.0 or Pillar 1. So much more companies may, and that's not already next year, but that will be decided and discussed next year. There's an international trend to lower that barrier. So really be mindful of having, let's say, international activities in other countries, and whether or not that creates any additional tax liability. That's really what we see now for global multinational companies.
These are two good points for Holland and also for the international tax avoidance, the double taxation avoidance, I should phrase it. This was highly interesting today. It's about cash, also bottom line. Remmel, thank you very much for being available and having you here. It makes it is always good to hear your advice. I wanted to wish you a good finish of the year and then a good Christmas season.
Great, thank you, Jörg. Joy to join, and well, we have one more week for Christmas to wrap everything up. So thank you.
Thank you. Have a good day. Bye bye, Remmel.